G'day lads, welcome to the video on how to do a cash flow statement. We're going to move pretty quickly, so if you need to pause, do it. First thing we have to do is work out our receipts from debtors. Okay, so we have to set up debtors T account. Debtors is an asset. Okay, we need 7 bits of information. First is opening balance, credit sales, discount allowed, bad debt, bank, which is the figure we're solving for, remember, and closing balance. Okay, so now we're going to go to the financial statements and figure out what we're doing. We're doing the question for Sammy's Seafood. Okay, so looking at the financial statements of that business, we can see that the opening balance for debtors in 2008 is $15,000. The credit sales for the period are $85,000. Discount allowed for the period is nothing. Okay, so that would be under other expenses. There's nothing there, so put that as a 0. Bad debt is, okay, so looking at the statements here, there is no bad debt. So we don't quite know that one yet. We don't know bank. We do have a closing balance figure, and that for debtors is $25,000. So we've got 2 unknowns, makes it really hard to solve. Okay, so what we actually have to do is set up the provision for doubtful debts T account to allow us to solve for bad debt. Okay, because if you actually notice looking at the statements that there is actually a doubtful debt, not a bad debt, a doubtful debt. Okay, and obviously a provision for doubtful debt as well, the balance sheet. Okay, so the effects that has, we'll see in a second. So the opening balance for PFDD is $1,000 in 2008. In 2009, the closing balance is $1,500. The doubtful debt for the period was $8,000. Okay, and remember the unknown here is actually the bad debt expense. Alright, so we can tally up on this side, carry it across, and then solve back to find bad debt. Okay, so in this case it'd be 9,000, take 1,500, it's going to leave us with 7,500. Alright, so what the process is from here from here is to figure out or to use that bad debt expense and take it up to the debtors T account. Okay, so this is the bad debt expense now we figured out. Okay, and now that we've got bad debt, now we can again solve back to find bank, because that's the figure actually concerned with here, is actually figuring out how much cash our debtors pay the business. Okay, so I'll add up the largest side, which is 100,000 on this side, carry it across, and then solve backwards to find the bank account. So $100,000, take 25, take 7,500. It's going to leave us with a bank, or the bank figure of 65.5. And that is our receipts from debtors, our first inflow in the cash flow statement. Receipts from debtors, 65,500. Okay. Remember we're doing this first step, not to forget cash sales as well. Cash sales are a cash transaction, so they go straight into the operating activity section of the cash flow statement. and the cash sales for the business were $60,000. Okay? Next step is to do creditors. Or to do the payments. So set up the creditors tier account, do the payments to creditors. 6 pieces of information we need here. They are opening balance, credit purchases, discount received, bank, again that's the figure we're solving for. Purchase returns, and closing balance. Okay, so picking through the statements of Sammy Seafood, we can see this again. All right, opening balance is $17,000 in 2008. Credit purchases of that business are $60,000. Discount received is $1,200. Purchase returns is $6,000. Closing balance is $14,000 for creditors. So add up the larger side, carry it across, and then solve back to find the bank account figure, which in this case it will be 77, take 14,000, take 6,000, take 1,200, gives us a payments to creditors figure of 55,800. So that's the figure we're concerned with, and that is an outflow of cash in the operating activities section. Payments to creditors, 55,800. And again, don't forget cash purchases. Which in this case, the business made cash purchases of $50,000. That is an outflow of cash, business paying for stock directly with cash. Okay, so that's the first and second steps done. Receipts from debtors, payments to creditors. Now we're going to do prepaids and accrueds. Okay, so the first step here is to look through the balance sheet. Do we have any prepaids and accrueds? Yes, we do. There are a few. Okay, in this particular example, there is prepaid interest as a current asset, and there is accrued commission as a current liability. So 2 calculations here to do. All right, so the first one we'll do is interest. So set up your buckets. Put the times in, 2008, 2009, okay? We know that we're clearly looking at prepaid interest here, the current asset section, okay? So we're gonna actually figure out whether that's interest revenue or interest expense. And the way to do that is using Papa Allah, so up on the right-hand corner here. We've got an asset, we know that's in the current asset section. We also have a prepaid. So an asset and a prepaid, therefore it must be an expense. So it's going to be interest expense. All right, so once we know it's interest expense, then we can go back into the statements and try to figure out what this amount here is, what the actual expense was for the period. Okay, so in this case here for interest, it was 7,600. That was our interest expense for the period. We know we've got prepaid, so that means our arrows are going to the left. And then it's a matter of putting in the prepaid interest at each period. So in 2008, our prepaid interest was 600. And 500 in 2009, therefore the total cash actually paid for interest expense during this accounting period is $7,500. Okay, that's that one done. Now we look at, so that's, you can tick that one off for prepaid interest. Now we go down to the other prepaids and accrueds, and there's accrued commission as a liability. Okay, accrued commission. It's a liability, we know, so using Papa Allah, it's a liability, it's accrued, therefore it must be commission expense. Okay, so I'll still over here. Set up your buckets. 2008, 2009. Commission expense. So inside the bucket goes the actual expense or revenue. So clearly it's an expense here. And for this one, it's 8,200 of commission expense in the financial statements. All right, it's accrued. It's accrued commission, so arrows are going to the right. In 2008, the business had $600 worth of accrued commission, meaning that it'll be paid in this period. And then in this financial year here, so end of this period, the business still owed $400, meaning it will be paid in the next period. So 8,200 plus $600 being paid in this period. Take the $400 we owe at the end. Means that the business is going to be paying for $8,400 worth of commission during the year, during the accounting period. Okay, so that is the prepaids and accrueds done. Now we have to do the rest of the income statement. Remember, operating activities relates to revenue and expenses only. All right, so now we've got to go through the income statement and figure out what we haven't yet touched. Okay, so going down the income statement, we haven't yet done commission revenue. Okay, we've done commission expense, we did that down here. We haven't done commission revenue. And that figure was 2,600, so that's an inflow of cash. Haven't yet touched rent revenue either, for 13,300. Haven't yet touched interest revenue either. They're all inflows of cash. Okay. Now we'll go through the expenses. That's all the revenues we've now gone through. All right, we've done commission and interest. All right, we haven't yet touched wages. All right, so we'll do that one. Wages is for $65,000. That's a payment of cash. Insurance. And then the last one we haven't touched there up in the COGS section is custom duty for $1,000. Okay, the ones we leave out, we've actually dealt with doubtful debts already in over here in the PFDD, and we've also already dealt with stock through the transactions of sales and purchases. So we've actually already dealt with those. And the other ones we haven't touched are depreciation. That is because they're a non-cash transaction. Okay, so that's the operating activities section done of the cash flow statement. And the next video we'll do the investing financing activities. Okay.